I spent the past couple of weeks looking at high-yield bond ETFs, and I think what I found might surprise you. It certainly surprised me. Si vous préférez regarder cette vidéo en français, je vais mettre le lien ci-dessous à ma série YouTube français, Vos finances, dans la description. First, let's talk about what a high-yield bond is. A high-yield bond is a bond, or debt, issued by a company that is either smaller or riskier, such that it gets a lower credit rating. These are commonly referred to as junk bonds. But the industry doesn't like that name because who really wants to buy junk, right? Most of the companies that issue high-yield bonds also trade on the stock exchange. So some of these are household names that you know, like Sprint or Bombardier, and some of them are smaller companies that you might not know. Because these companies are riskier, you generally want to hold them by the hundreds. You don't want to hold just a handful of high-yield bonds in your portfolio. That's where ETFs make it really easy to do. And when you hold them by the hundreds, you don't have to worry about any one of those companies going bankrupt. It won't damage your portfolio. Now, the Canadian market for high-yield bonds is pretty narrow. There aren't so many out there. So for Canadian investors, it's better to look to the US market for high-yield bonds where you can actually get decent diversification. iShares and BMO both put out ETFs that buy US high-yield bonds and hedge the currency back to Canadian dollars. In other words, they strip out the fluctuation of the Canadian-US dollar exchange rate, which is a good thing because if you're buying high-yield bonds for income, you don't want to take that risk. One of the big reasons I'm taking this closer look at high-yield bond ETFs is the fact that they're more expensive than the average ETFs. MERs, or management expense ratios, for these ETFs run 0.6 to 0.7%. Another big reason why I'm taking a closer look is that they tend to exhibit higher tracking error. Tracking error is the difference between the return the ETF provides and the return on the underlying index that it's trying to mimic. In the case of high-yield bond ETFs, they've been lagging their indexes by anywhere from 0.2 to 0.9% per year over the last 10 years. And that's over and above what was explained by just the fees alone. So if you've got 0.2 or 0.9% slippage on your portfolio, essentially, that is not something you want. You may think this is only for the Canadian ETFs, but when you look at the big US high-yield bond ETFs, the same holds true. JNK and HYG, issued by State Street and iShares respectively on the US stock market to hold US high-yield bonds, have the same magnitude of slippage against their indexes. So the question then becomes, what are you going to replace these with in your portfolio? We took the returns for the last 30 years on the US high-yield bond index and regressed that against the movements of the Canadian aggregate bond index, or all high-quality investment-grade bonds, and the US stock market. The result of that regression analysis essentially shows that if you build a portfolio of 60% Canadian high-quality or investment-grade bonds and 40% US stocks, you explain the lion's share of the movements in the high-yield bond index. You get the same return over the last 30 years, and it's even a little bit less volatile. So this is really a winning combination. We've taken a more expensive high-yield bond ETF and replaced it with two much less expensive high-quality bond and stock ETFs that have much tighter tracking error. So the result is a huge win in your portfolio. You've shaved 0.5% off your fees, and you're tighter to your benchmark and getting your actual return that you expect. This is a really good example of what portfolio management is and is not. Portfolio management is not about picking stocks and trying to time the market. Portfolio management really is about capturing the market return as efficiently as you can and squeezing out any of those little inefficiencies that you can find in the way you do that. Are you as surprised by this as I was? If so, please write me your thoughts below. I'd love to engage in a conversation and hear what you think about it. I'm Peter Guay, portfolio manager at PWL Capital in Montreal. I publish videos like this every 2 weeks, so subscribe to my YouTube channel to be notified next time a new one comes out. Thanks so much for watching.